Good afternoon and welcome to the lecture 28 of ETC 779. In the previous lectures on construction accounting, we have discussed the basics of accounting, especially construction accounting. We have discussed the different steps that the accountants employ in arriving at the balance sheet as well as the profit and loss account. We have also seen what are the different ways in which revenues are recognized for a construction project. Now, in this particular class, we are going to discuss about profit and loss account, balance sheet and working capital. So, these are the three aspects we want to cover in detail in this particular lecture. Now, if you remember the previous lectures, we had discussed 7 steps before arriving at the profit and loss account as well as the balance sheet. Those were initiation of transactions, recording of these transactions in a chronological manner. Now, these recordings we were doing either in the cash book or in journals. Now, these in addition to these recordings, we had some adjustment entries which were recorded at appropriate places as and when we required the profit and loss account or the balance sheet. Now, we will try to see what are the different components of a typical profit and loss account, which is also known as an income statement, and what are the typical components that you find in a balance sheet. We will restrict our discussion only to those accounts statement which relate to construction companies. And then towards the later part of the lecture, we will also be discussing about working capital. What is working capital? What is net working capital? What is gross working capital? Why working capital is important? What are the different ways through which we can economize on the employment of working capital? These are certain details we would like to cover in this particular lecture. Before going into the details, we would just like to recollect some of the things which has already been covered in previous lectures. For example, we discussed about assets, but we did not discuss about the types of assets. So, you can find as in this particular slide, there are broadly 2 kinds of assets. One is known as fixed assets, for example, your land, the office building, the plant and equipments that the company has, and the different furniture, office furniture, these are part of the fixed assets. Now, there are current assets. For example, the stock that the company is employing for doing different construction activities. It could be concreting, it could be plastering, it could be aluminum works, it could be structural glazing works. So, in order to achieve these tasks, the companies do have some stocks. Now, those stocks are part of current assets. Then you have debtors. This we already discussed why they are called assets, and why they are called current asset is because these are those type of assets which are of very short duration kind. For example, less than 1 year. We will see this definition in detail when we cover the balance sheet portion, but for the time being just understand that stock is part of your current asset, debtors are part of your current assets, then you have cash and bank balances, they are also part of the current assets. Now, coming to liabilities, as you can see, it represents the money which is made available to the enterprise or the company. So, basically this is the contributions by the owners as well as the outsiders. For example, if you remember the previous exercises which we were doing, in which we had one Mr. David who had from his bank account taken some money and opened a company. So, that is classified as the owner's fund. The owner has put in certain amount of money to start a company. Then in the same example, we also took certain loan. In one case, we got bank loan. In one case, we took loan from Mrs. David itself. So, they are part of your loans provided by outsiders, and they all put together are your liabilities because the company owes them. If you try to see the difference between asset and liability, asset is those which the company owns it, whereas for liabilities, they are the ones which the company owes it. So, these are the primary differences between assets and liabilities. As you can see from this particular slide, there are different kinds of liabilities. For example, it could be the owner's funds. For example, Mr. David has provided some money out of his savings to start a company. So, that is part of your owner's funds. Then you borrow funds. Here again the borrowing could be either on the long term basis or on the short term basis. So, accordingly they are classified as long term loans or short term loans. So, they are also part of liability. Then you have creditors. You know why creditors are your liabilities? Because the company owns some amount from these suppliers, from these vendors. So, they are your creditors. They are supplying you money, they are supplying you material, but you have not paid them yet. So, you as a company owe to them. So, that is why they are part of your liabilities. Then similarly, the customer advances. You might see in most of the construction projects you get mobilization advance. So, basically the mobilization advance, although you may be getting it, but you may not have worked to that much extent, and that is why the company owes that much money to the client, and so that is why they are characterized under liabilities. So, you have customer advances. If you have not done work equivalent to that much amount, will be part of your liability. Now, we will go into the details of profit and loss account. You remember we had done one simple problem in which we had tried to calculate how much profit or how much loss the company has paid during a particular period. Profit and loss statement is always made for a particular period, maybe from 1st of April of a particular year to 31st of March. So, this is a whole period, whereas balance sheet, if you try to recollect, it is basically a snapshot, a picture taken at a particular instant. So, always you will find the profit and loss account are reported for a particular period, financial year. It could be for 1 year starting from April to March, or depending on what kind of financial year you have, these statements are prepared. Now, the basic objective of preparing profit and loss account is to know whether the enterprise is making profit or losses. So, at any point of time, if you like to see how much gross profit the company has made, what are the taxes that the company is paying, and what is the net profit after taxes and all other deductions the company has made. So, it is basically giving you the health of the company as far as the objective of company is concerned. For most of the companies, you will find that the objective is to make profit if they are part of the private sector organizations. Now, if you look at the typical profit and loss account, you will find that they contain following informations. In the last class, I believe I had given you one assignment to see a particular, or for that matter, see a annual report, see an annual report for a construction company. So, an annual report will give you all such details. They will have profit and loss account, they will have balance sheet, and then they will have different annexures. For example, it will contain director's report, auditor's report, all those things you will be able to see it in an annual report which is published annually by the company. Now, any typical profit and loss account will contain the information on gross profit. It will also include the details of the various costs that the company has incurred during that particular period. It could be direct cost, it could be indirect cost. So, all those costs could be compiled and they will be shown in this particular piece of paper. Then, in addition to your main business, sometimes companies do invest in some other companies also. For example, let us assume that there is a company ABC which is primarily into construction, but you will find that the company might have spent some amount or might have invested some amount in some IT companies, information technology companies. So, those are also those investments also will generate certain income, certain amount of income. So, those incomes are shown separately. So, you will also have to see that what is the income that the company has made from other investments apart from the main business. Then the profit and loss statement will also show you the interest that the company has paid, maybe for having certain amount of capital that it might have borrowed. So, how much interest is paid? These things sometimes it may be part of your cost itself. Now, when you look at the profit and loss account, you will also find what are the outstanding expenses, what are prepaid expenses. These things you may note it down. When I show you a real profit and loss account of a typical construction company, you will be able to find them. Then you will also find the information on income received in advance. You may not have done a particular work, but you might have received certain money, right, in the form of an advance. So, that is also to be shown. Then it gives information on depreciation. It gives information also on the bad and doubtful debt. Suppose you find that you have worked for a particular client and you feel that that particular client is not going to pay you. So, that also you have to show it in your profit and loss account. How much you feel that the bad and doubtful debt could be there as far as this particular company is concerned. So, that also information is desirable as far as profit and loss account is concerned, because as an outsider, if I look at it, if I find that the particular company has got too much of bad debt, I may not have that much confidence in that particular company. So, that is why these informations are also shown. Now, I am just giving you a typical profit and loss account for a company. You will find that it is quite a lengthy statement. I have tried to split it into different slides, otherwise it would not have been visible. So, what you can see, it gives you two broad things. First part is income, and then second part is related to expenditure. So, under income you will find income from operations. Operations is the main business. If the company is solely into construction, so this income that has been generated out of different construction activities will be shown here. Now, it will have two columns, one for the current year and one for the previous year. Sometimes you will find these values shown for 3 years, so that any investor looking at these values can infer so many things. For example, whether the incomes are growing or whether there is a decline in the income from the construction business, whether the profit before tax has gone up over the years. So these are some of the informations that any outside investor would like to know. Even as an employee of the company, you would like to know whether your company is making profit or loss. What is the percentage increase in profit? All such things will be of great value to you as far as an employee is concerned or maybe an investor is concerned. Now, sometimes you may be participating in a joint venture also. There are many situations in which two or more companies form a joint venture, JV. Suppose you are going in for a very specialized kind of a job or a project. Your company alone may not be having expertise to do it alone. So what you do? You try to club with few more companies. These companies will be part of your team and they are rather supplementing you in some other activities in which you feel you are not the expert. So that is how for large projects, mega projects, companies form joint venture and then they bid together and then they are awarded the job and then they execute the project. Maybe some company may be providing the human resources. Some company from the joint venture may be providing the equipments. Some company may be providing the technical informations that is required to execute a project of that nature. So that's why you try to club the strengths of different companies and form a joint venture for the successful execution of mega projects. So from that joint venture, whatever is your income, that also you write. Sometimes joint ventures are registered as a company itself. So it may so happen that there are three companies A, B, C. They have different independent business, but for a particular project, they may form a joint venture company XYZ in which A will have some share, B will have some share and C will have some share. And once this particular project is over, that company will cease to exist. So that kind of arrangement possibly could also be there. There are different kinds of JV arrangement. Maybe in some other class we will discuss in detail. Now you will find what is the company's share in profit or in loss of integrated joint ventures. So once you have certain amount of percentage involved in a joint venture, you will carry forward the profit or the loss in that proportion only. Suppose a joint venture company having three partners A, B and C, they have made a profit of 100 lakhs or 100,000 and their responsibility is in the ratio of 30%, 40% and 30%. So that profit or loss also gets divided in the same proportion. So whatever is the profit or the loss, that you bring it from there and try to put it in your balance sheet, profit and loss statement. So these are as far as income is concerned. Now you must be finding, if you look at the slide very carefully, you will be finding, for example, in other income, you have a K written over there. Similarly, in construction expenses, you have a term, you have a letter L written there. Now these are called schedule. Schedule K, Schedule L, Schedule M, Schedule N. Now if you look at the annual report, these schedules will be provided as part of annexure. That means the information related to, for example, construction expenses. If you want to look at the details of construction expenses, you have to go and check in Schedule L. It is kind of a annexure or attachment. So income statement is a summary of different incomes as well as different expenditures. Now detail of any income you want to see, you have to go to the respective schedules. So there are n number of schedules which are part of your profit and loss statement. As you can see from this example, there are different schedules K, L, M, N, and there are many more. So, now under expenditure you show what are your construction expenses, how much remuneration and welfare expenses you have incurred towards your employees, what are the expenses towards office and site establishment. All these things are there for this year, that is current year, as well as for the previous year. For example, if you see the office and site establishment expenses, the last row of this particular slide, you find that in this current year you have spent 96.65 lakhs or crores or thousands, whatever is the unit, that much money. Whereas in the previous year for the same expense head you had incurred 71.57. So, this way you can analyze that, okay, that means in this particular year company has spent more on office and site establishment expenses, the company has paid more on employees remuneration and welfare expenses. Similarly, the construction expenses have also gone up from the previous 1601.11 to 1837.03. Now, if I want to look at the details of office and site establishment expenses, I have to go to schedule N, and then I can see, okay, these are the details. So, this particular sheet is giving me the summary, the total, the details are found elsewhere. Now, for interest, again you can see there has been an increase in interest from 41.39 to 61.97, and details of this you can find it under schedule O. Then the details of depreciation. Depreciation, if you remember, it is considered as part of your expense, but no real money flows out of your pocket or out of the company's balance. So, it is all notional expense. So, what you can find from these informations, you can get the profit before tax and exceptional items. I will tell you what exceptional items. Sometimes some companies may transfer their development rights or they may sell their patent. These are not very common, but sometimes that may also take place. For example, in this particular example you have seen, you can see that last year the transfer of development rights was equivalent to 40 lakhs, whereas this year there was no transfer of development rights. So, that is why that figure against that particular column is blank. So, you can calculate what is the profit before tax. So, you can find that the profit before tax has come down. Previous year it was 138.27, whereas this year it is only 117.89. So, you can infer that, okay, the company has increased the expenditure, it has not generated a proportionate amount of income. So, that is why the profit is coming down. Maybe the company may be employing too much of facilities at their head office location, at the site office location. So, these kind of inferences you can make once you have such kind of data. Now, once you have got profit before tax, then you include different provisions. For example, provision for current tax, provision for deferred tax, provision for fringe benefit tax. These are different tax component which you will have to account for. Sometimes it may so happen that you are preparing the balance sheet as well as income statement, but till that point of time you may not be knowing the exact amount of these taxes that you would be liable for, because these taxes they vary year to year. For example, this year it could be 35% tax, maybe next government comes next year, it may either increase the tax or it may decrease the tax. So, in order to take care of such things, you have certain provisions. Now, when you actually pay the tax, that time you will be knowing your actual value, and then while preparing the next profit and loss statement, you can adjust it. Now, we will see some more. So, for example, profit before earlier year's tax. Now, these are the adjustment, because while preparing the previous year's profit and loss account, they might have taken the provision. Now, those are getting adjusted over here. So, and finally, all these things are leading you to net surplus after tax. So, this year it is quite less compared to the previous year. For example, this year it is only 79.28, whereas the previous year it was 124.80. Now, if you look at the value of amount available for appropriation, the 200.06 is available for appropriation. That means this much profit the company has made, and now the management has to decide how to distribute this profit. How much profit to be distributed in the form of dividend, how much profit you want to keep it with you for further investment, those are part of your retained earning. So, that will be treated again as your addition in liability. Then from these you calculate how much reserve you would like to keep for unforeseen measures, and then finally how much you want to carry to balance sheet. Now, you have a figure called EPS, earnings per share. So, once you calculate how much money you are trying to distribute, you know how many shareholders are there with you. So, you can divide it based on the predefined values or predefined formulas, and then accordingly you know how much earnings per share is generated in this particular year, in this particular financial year. Now, a company generating more earnings per share, naturally their shares will be selling like hotcakes. But the company which doesn't generate much earnings per share, naturally they will not be valued much by the shareholders as well as the future or would be investors. So, this is one very important figure, earnings per share, which would be investor would be interested in knowing it. And that is why everybody will try to look for the profit and loss statement, and finally they see what is the bottom line, how much money you are distributing to your shareholders. Now, we move on to balance sheet. Now, balance sheet, as you can see, it is a statement prepared to know the exact financial position of the business on the date of preparation. So, this particular line on the date of preparation is very, very important, as I have been repeatedly pointing out, because this is the snapshot. The picture may change if the time changes. So, that is why the day is specified on which you are preparing the balance sheet. Normally, balance sheets in India is prepared as of 31st of March every year. It may be different in different countries. So, what companies do, they will take that as a datum and then see what are their assets as on that particular date, what are their liabilities as of that particular date. Now, balance sheet, if you look for any construction company, it will give you these four things. For example, it will show you the status on a particular date. As I told you, it could be either 31st March or 30th June or maybe 30th September, like that. It will give you the status of what the company owns. That means it will give you information on the different assets that the company has as of that particular date. Remember, that particular date is very, very important, because companies do incur transactions or do have transactions on a continuous basis. So that's why a particular date is frozen. On that particular date, what is the status of your asset, what is the status of your liability, those things are important. Then the next thing that you will see in the balance sheet is the status of what the company owes. That means the company's liabilities. And you will also find that there is a particular order that is followed while listing out the different assets as well as while listing out the different liabilities. So normally they are written in the order of liquidity. We will see what does this mean. For the time being, just understand that balance sheet is prepared as of a particular date. It shows what the company owns, that is the asset part. It also shows what the company owes, that is the liability part. And they are listed in the order of their liquidity. We will see what this means. Now, a typical balance sheet will have a layout like this: liabilities on the left hand side, assets on the right hand side. But there are different formats of showing the balance sheet also. For example, in one convention, assets you write at the top and liabilities you show at the bottom. Now, using the top and bottom convention, we had done our exercise in the previous lectures. But this is how also in some countries balance sheet is presented, in which your liabilities are shown in the left hand side and you show the assets on the right hand side. This is also one of the ways in which balance sheet is shown. Now, if you look at the liabilities, it starts with shareholders funds, share capital, reserves and surplus, loans, secured and unsecured loans. Then it lists out current liabilities. We discussed some of it. For example, creditors, sundry creditors, bank overdraft, bills payable. So what do you find? Those liabilities which are of long-term nature are shown on the top, and those liabilities which you have to meet in next few days, next few months, in less than a year time, is shown at the bottom of it. Now, if you look at the assets, you have different fixed assets, for example, land and buildings, plant and machinery, furniture and fixtures, investments that you make in different companies, current assets under which you have sundry debtors, stock, cash and bank balances. We will see a typical balance sheet, but before that, you can see in this particular slide, there is a balance sheet of a construction company which has been drawn as of 31st March 2007. This date is important. That means this balance sheet is giving you the picture or the status of that particular company as of 31st March 2007. Now look at this and look at this and see what are the different heads that are mentioned, or what are the informations that are mentioned under this type of balance sheet. For example, it will show you the sources of funds, and then it will show you the uses of funds or application of funds. Now, when you see the sources of funds, it is nothing but your liability part. You have taken some fund from someone, so that is your liability. You owe that person or that company that much money. So, for example, the funds could have been mobilized by the company in the form of share capital. Now, under share capital you will find Schedule A written. So, Schedule A, if you refer, it will give you how many shareholders are there with the company, what is the value of each of the shares, and that way they will give you the total thing, and from there they bring that information in this particular sheet. So, details of share capital you will have to refer to Schedule A. Then comes reserves and surplus. The information on this is available in Schedule B. So, the total shareholders fund would be A plus B, which is equal to 904.08 as of 31st March 2007, whereas it was 889.81 as of 31st March 2006. Here also you will have normally figures for this particular date as well as the same date in the previous year, so that the comparison becomes easy. Then comes loans. It could be secured loan, it could be unsecured loan. We will see what are these type of loans. So, the total loan is coming to be 1551.06. The previous year for the same date it was 1195.90. Then here also you will have deferred tax liability. So, the total is sum of all these things. Now comes application of funds. Fine, the previous slides told you about how much is the source of fund, rather what is the total amount of fund that the company has generated. Now, in further slides you will see how the company has used that fund. That means where the company has applied those funds. So, the company has these things listed under different heads. For example, it is fixed assets. Under that you have gross block, for which the details are available at Schedule E, less depreciation. So, net block value is 746.16. Then it also gives you the details on items awaiting completion or commissioning. There could be different things in your project, different projects which may require the client's certificate as far as completion and commissioning is concerned. Once they give you certificate, then only your bill is realized. So, you can find the total fixed assets both for the current date as well as for the previous year's same date. Now, come to investments. The details you will find it in Schedule F. Now, this particular slide, which is part of your application of funds, is giving you the details on current assets, loans and advances. Now, when you tell current asset, basically they are to be for short duration. For example, inventories. Inventories, we believe that it will be sold out if required within a period of less than 1 year. So, whichever asset you feel that it can get converted into cash within a period of 1 year, we are terming them as current asset. So, this is normally the convention, and this is how the current asset is defined. You may like to note it down. Current assets are those assets which company is quite hopeful of converting them into cash within a period of less than 1 year. If it will take more than 1 year time to convert it into cash, we call them as fixed assets. For example, buildings, land, these are our fixed assets, because if you try to convert them into cash form, it is not that easy. It will take sometimes more than a year to convert them into cash, and that is why they are classified under fixed assets by convention. Now you have inventories as current asset, debtors are also part of your current asset. Cash is the most liquid form of current asset. So anything that is available with you is having full liquidity, 100% liquidity. Suppose the money is there in the bank, it has lesser liquidity, because you may have to go to bank, or it will take some time at least to realize that money. So this is of lesser liquidity. Now there are debtors, they are also your assets. Suppose somebody owes money to you, right? You may have to follow up with him, and it may require some time before you get the hard currency. So that's why they are all part of your current asset. So all these informations will be listed out in the balance sheet. Then you have again loans and advances. The previous loans and advances we discussed, that was long term loan. Now these are short term loans. For example, current liabilities, then provisions, you might have kept certain provisions for taxes. So those things are coming here. So from here you can calculate the net current asset, you can also calculate the net current liability. Now these are part of your balance sheet. All these slides I will be sending you today itself, and so you need not worry about this, right. For example, I told you that the details are available in different schedules. Now this is the detail of one schedule, which is schedule G. For example, if you refer to previous things, this particular slide you can see current assets details are to be found in schedule G. So what I have done, I have given you a slide of schedule G also. So if you look at the schedule G, it will have these informations: current assets, under that stores, spares and embedded goods at cost. How much material is there in your store, what is its value, so that is written. How much spare parts are available in your stores, what are their values, so you will be finding it from here. How much fuel you have stored in your store, so that is also available here. Material in transit, you must have paid some money and the material you may not have received, that is also part of your asset. Then work in progress, these things we discussed while we were discussing that small example. Then uncompleted contracts and value of work done, then less advances received, other recoveries, less related site mobilization expenses, and then you have retention money. So this is part of your schedule G, it is giving you all the information. Now the value of current assets which we were getting in the balance sheet is taken from this schedule. So likewise, accountants prepare all these schedules in detail, and only the summary or the total value from these schedules are brought down to the main balance sheet, so that anyone who wants to see in one go what is the status of the company as of a particular date, they can easily find it out. Now this problem you note it down. So based on the previous lectures as well as the lecture that we have it today, you can try to prepare the profit and loss account as well as the balance sheet for this particular problem. Can you see this particular slide? Technology class? Yes. Okay, I will read it out also. So the different transactions are given. For example, first one is purchased materials for rupees 7549. A particular company has purchased materials for rupees 7549. Paid salaries rupees 678. The company has paid 678 towards salaries. Paid for telephone charges rupees 928. This is just an hypothetical example, so don't see this figure and get confused, because salary is lower than the telephone charges. You may notice it from here. Interest on loan paid rupees 36. Income tax paid rupees 236. Sold goods for cash rupees 9959. Borrowed loan from Citibank rupees 1324 by giving the machinery as security. That means against a particular equipment you have got the loan of rupees 1324. Purchased machinery for rupees 1324. Okay. So, just try to prepare the balance sheet as well as the profit and loss account using these transactions. I have prepared the solution also, I will mail it to you. This is there in this particular slide itself, but I will not show you. Now, we will discuss briefly about the annexes to the balance sheet. There are different annexes attached with the balance sheet. If you look at the annual report of any construction company, it will have n number of annexes. For example, it will give you the auditor's report. So, auditor's report will tell you that so and so company has followed the established accounting practices and their accounts are checked and verified. So, that certificate also will be part of the balance sheet. Then it will also contain director's report. For example, whoever is the director, it will have a message from him saying that this year whether it was good or bad for the business, what are the new things that they have been able to do, what are their plan for the next year, whether any new whether any new person has joined on key positions. For example, whether any new general manager has come from somewhere. So, all these things, what are the prospects, has any sale of major equipment taken place, have they purchased any major equipment. So, these things will be part of the balance sheet, a full page or maybe 2-3 pages director's report. Then the different notes, some countries they call it notes, some countries they call it schedule. So, either you can call schedule A, B, C, or you can write notes A, notes B, notes C. So, they are one and the same thing. So, there are n number of notes or schedules giving details of different heads which are part of your balance sheet. Then significant accounting policies it will mention. Then it will also reveal the related parties. Then different segment reporting also will be there. You just try to have a look at it and then you will see that okay, these are the different reports that a balance sheet also contains. Now, can we start a new topic, working capital? Okay, we have about half an hour more. Okay, we will try to introduce you to the working capital also. See, working capital basically means the capital which is required to meet the day-to-day expenses of an organization. Now, it is basically the excess of current assets over current liabilities. So, you have certain amount of current assets with you. which you get it from the balance sheet, and then you also are familiar of the current liabilities. So, the difference in these two, that is defined as the working capital. Now, if you see current assets, already we have discussed, any asset which can be converted into cash in the normal course of business within 1 year. So, this value of 1 year is very significant. More than that, if you find some assets may take to convert it into cash, those are classified under fixed assets. Similarly, current liability, if you try to define, it is basically, these are different components of current asset we have already discussed. For example, cash in hand, bank balances, your stock, your outstanding. Outstanding is basically how much money is with the client which he has not paid to you, although it is due to you. Suppose you have done a billing of 100 lakhs or let us say 100,000. Now, out of this, the client might have paid you only 70,000. So, 30,000 is the outstanding as far as the company is concerned. So, this you are likely to get it within a period of less than 1 year. So, they are also classified under current assets. Then you have prepaid expenses. For example, you might have ordered some material and you might have paid advance to your vendor. So, these are called prepaid expenses. This is also part of your current assets. Then different deposits that you make, those are also part of your current assets. Now, current liability, if you see, it is the money owed by a business or any liability which is to be paid within 1 year. So, here also the value of 1 year is significant. More than 1 year, they are called long term liability. But any payment that you have to make it within a period of less than 1 year, that is to be treated as current liability. So, that 1 year value is very, very significant. Now, if you see this various types of current liabilities, it could be vendor credit. For example, you might have got the work done by some agency, some subcontractor, some vendor, but you may not have paid to him. But his payment is due within next 1 year. So, then that is part of your current liability. Then similarly, advances received from client, that is also part of the current liability. Sales tax payable and other payable items, these are all part of your current liability. Deposit received from subcontractor. Suppose you might have taken some amount of performance guarantee from your subcontractor, and the subcontractor's project is for 3 months only. So, after 3 months you have to return his amount that is with you. So, that is why it is also part of your current liability. Now, from the items that I am going to give you, just try to identify which one is current asset, which one is current liability, which one is long term asset and which term is long term liability. Advances paid to subcontractor, is it part of current asset, current liability, fixed assets, long term liability? Just try to think over these things. Prepaid expenses, plant and machinery, sales tax payable, stock, deposit paid for rent as well as for electricity. Outstanding, outstanding is the this we have already discussed. Basically, this is the money with the client, the remaining amount of money which is with the client and it has not been paid to you, although you must have done the work for that much amount. So, that is called outstanding. Land and buildings, advances received from client. So, just to start with, advances paid to subcontractor, prepaid expenses, plant and machinery, sales tax payable, stock, deposit paid for rent and electricity, outstanding, land and buildings, advances received from client, wife, credit received from suppliers. This you can think which one is your long term asset, current asset, current liability and long term liability. Now, if you look at the definition of working capital, as we have already discussed, it is basically current asset minus current liability. Now, current asset is also sometimes referred to as gross working capital, whereas the working capital, current asset minus current liability, that we are calling them as net working capital. So, please try to note the difference. If you are subtracting current liabilities from the current asset, that is called net working capital, whereas the current asset, if you take all put together, they are known as your gross working capital. Now, I think this is how we define these working capital part. The working capital, why it is required, what are the different components of working capital, and why working capital management is required, we will be taking up in next class. Besides that, we will also be discussing about how to raise the working capital, what are the different sources through which we raise the working capital. And then in one more class, we will be talking of ratio analysis. What are the different ratios? What should be the ideal values for a construction company? How do you interpret different ratios? These things we will be taking up in one of the lectures. So, altogether I have a plan to cover this particular course in 2 more lectures. So, if we get a link like whatever we have got today, we should be able to finish it by this week. So, your ETC 779, we are hopeful of completing it by this particular week, and then next week onwards I have a plan to start your ETC 769. So, any doubt you have technology class? Slides you will, okay, thank you. This transparency or slides you will be receiving it by today. Thank you.
Okay, thank you. Bye.
Yes.